Welcome to this week's Money Metals podcast, helping gold and silver investors during these turbulent times. Now, here's this week's market wrap with commentary and analysis from the low-cost precious metals dealer voted best in the U.S., Money Metals Exchange.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up, Larry Parks of the Foundation of the Advancement of Monetary Education joins me for an eye-opening discussion on our nation's growing monetary problems and what you can do to help the vital cause of bringing gold back into the nation's consciousness. Larry also talks about some pretty shocking problems at most pension funds, so don't miss our interview with Larry Parks, one of the foremost experts on sound money, coming up after this week's market update. Well, as traders on Wall Street take time off for Thanksgiving, they can be thankful markets are calm and equity averages move steadily higher. Of course, the stock market and the banking sector in particular is being artificially propped up by regular liquidity injections from the Federal Reserve. So perhaps Wall Street should give its thanks to Fed Chairman Jerome Powell and his cadre of central bankers. Powell gave a speech on Monday in which he stated interest rates were, quote, well-positioned. In other words, he sees no need for further rate cuts, at least for the time being. But Powell did vow to create more inflation. In Fed-speak fashion, he said the Fed would not wish to, quote, permit an unhealthy downward drift in inflation expectations and inflation, end quote. He reiterated the central bank's goal of keeping the annual inflation rate around 2%. Should everyday consumers be thankful for the fact that prices for household goods, medical care, insurance, education, and housing are all going up? Should savers be thankful for the fact that their dollars are losing value because of the arbitrary monetary policy decisions of an unelected and unaccountable Federal Reserve Board? Perhaps not. But then, perhaps monetary policy isn't designed to benefit the masses in the first place. Perhaps instead, it's tailored to fit the needs of bankers and politicians. For now, Fed policy is also juicing stock market returns, but we know from history that when monetary inflation is injected into the financial system, it creates unsustainable bubbles and unintended consequences. When the party finally ends on Wall Street, inflation will again become an enemy rather than a friend to investors, and those who are now entering the stock market at these elevated levels could end up being regretful. Investors who have diversified into physical precious metals will be thankful that their wealth can't be wiped out by gyrations in financial markets or failures in the banking system. They know at some point, hard assets will shine. As for this week's action in precious metals markets, gold and silver drifted slightly lower through Wednesday's close. The gold price ended New York trading on Wednesday at $1,455 per ounce, down 0.6% since last Friday's close. Silver was off 0.5% ahead of Thanksgiving to trade at an even $17 an ounce. Silver remains a bargain hunter's delight. It's not only cheap in terms of dollars, but also in terms of gold. For the price of a single ounce of gold, you can buy just over 85 ounces of silver. Most metals investors who know something of the history of the gold-silver ratio would rather own 85 ounces of silver than a single ounce of gold. Earlier this year, the gold-silver ratio reached a once-in-a-generation high of nearly 95-1. Although it has since come down some in favor of silver, gold's price premium remains quite elevated historically. As recently as 2011, the gold-silver ratio traded at just 32-1. Further back in history, it has found popular acceptance at 16-1. Another metal that is trading at a big discount to gold is platinum. It ended the day on Wednesday at just $898 per ounce. However, its sister metal, palladium, trades at an unusual premium to gold. The palladium price checks in at a lofty $1,837 and appears headed for a record-high close on the heels of a weekly advance of 3% as of Wednesday. The markets are open Friday, albeit with an early close, and Money Metals is open for regular business. As holiday shopping season kicks off, we hope you'll consider some of the many ways to give the gift of sound money to loved ones. Money Metals Exchange stocks bullion for all budgets, from copper rounds that can be stuffed into stockings to pure 24-karat gold for that special someone. If you're looking for affordable bullion gifts that come ready to give, you'll want to order a handful of our holiday-enhanced Silver Eagles. We are pleased to offer the world's most popular silver coin, the American Eagle, packaged in our exclusive Merry Christmas capsule. This gleaming pure silver coin is a great alternative to cash, gift cards, and other run-of-the-mill presents. But the truth is, precious metals in any form is virtually guaranteed to bring bigger smiles to people's faces than the equivalent value represented in paper or plastic. There is nothing like the timeless beauty and tangible weight of a bullion product. It leaves a lasting memory. The gift of precious metals can be cherished for years or even decades to come. It can help teach children about the value of money, the risks of inflation, and the long-term benefits of saving. Unlike popular gifts such as clothing or electronics that will wear out or become obsolete over time, any quantity of precious metals stands to become more, not less valuable over the years. Well now, without further delay, let's get right to this week's interview. It's my privilege now to welcome in Lawrence Parks, founder and executive director of the Foundation of the Advancement of Monetary Education. Larry has dedicated much of his life towards the study and promotion of sound money, having authored articles that have appeared numerous times in publications like The Economist, The Washington Times, National Review, and The Wall Street Journal, just to name a few. He even hosts a weekly TV show that airs on cable networks in the Manhattan area called The Larry Parks Show. He has given expert testimony in Washington to the United States Congress on monetary policy. He's a real champion for sound money, and it's great to have him on with us today. Larry, thanks for the time and welcome. It's good to talk to you.
It's a pleasure. Thank you for hosting this.
Well, Larry, to set the stage here, briefly give us some background about the Foundation of the Advancement of Monetary Education and what motivated you to take the helm of the organization nearly 25 years ago. Let's start there.
I had been in the money management business, and I had noticed along the way that I was getting severe distortions in the valuations of the stocks that we used to cover. And I had known about the money issue. I had studied at one point with Murray Rothbard, and it wasn't my intention right from the very beginning to do this. I tried to get other charities, other think tanks to pay attention to this, and nobody would touch it. Turns out there's a good reason for that. And somebody suggested to me along the way, why don't you do it? And I ended up doing it. And when we got started, we had all of the work that Committee for Monetary Research and Education, that was Elizabeth Currier's group, did. She had several hundred monographs, a couple of which were authored by me. We had all that digitized. The people at the Foundation for Economic Education, that was Henry Svenholz at the time, they had all the work of Henry Hazlitt. I don't know if you remember that name.
Sure.
He was from the Times. He wrote a book called Common Sense Economics and stuff on gold. We had all that stuff. I recruited roughly 30-some-odd board of advisors and board members, some of whom had worldwide reputations, and we were off and running. And I thought that the gold space, especially the gold companies, would sponsor our work, but that never happened. And it's very interesting about how the people on the other side, on the paper money side, were able to co-opt just about everybody and promulgate this, what I call imaginary fake money, into society on a worldwide basis. It's just utterly remarkable they got away with this.
Now, you've made the point that gold is the most important of all the commodities in the world, even more so than oil. Explain why you believe that to be the case, if you would, please.
The reason gold is the most important commodity is that gold is the only way to ensure payment. And so the way I like to explain it is that the glue that holds society together is keeping promises. So, for example, I make up with you, I'm going to be available at 3 o'clock today. If I don't keep my promise, that hurts the relationship. But the promises that are most important in society, aside from the promises that we make to family and friends, are the promises to pay pensions, to pay annuities, to pay savings, to pay rents, whatever. If those promises get broken, society unravels. And so what happens is that people who have promises of payment, like take pensions, for example, pensions are really deferred wages. They depend on that promise being kept. And in turn, they make promises to other people, mindful that they're going to get paid. And if that chain gets broken, all of the interrelationships in society break down. And we've seen examples of that from all recorded history. And the thing about gold is that gold is the only way to ensure payment over a long period. People think about gold as money. They think about going to the grocery store. That's absurd. Nobody would use gold, for day-to-day transactions. Gold is important for payment into the future. And so whatever it is that you use as money, say, for example, you use water, some of that water is going to spill. In the case of gold, you have no spillage. And the guy who really put his finger on this the best was a guy named Karl Menger. He's part of the so-called Austrian School of Economics, picked up at von Mises by Rothbard and others. And what they said was that gold is the most saleable, most, how shall I say, most efficient money. And the way they measure that, and it's really ingenious, if you look at all the things that could possibly be money and the things that have been money, things like salt, cattle, copper, steel, all kinds of stuff, and you line them all up and you offer ever-increasing amounts of each into the marketplace, commodity for which the buy-sell spread increases the least, that's the most efficient money. And it just so happens that's gold. And no matter where you drop in history, either in ancient times or in Renaissance times, today, say in the 19th century, cross-culture, cross-time, you see people using gold as money when it's available. So it's not like somebody came down from the heavens and said, look, in China, in the Mideast, in Europe, you have to use gold. Somehow, by trial and error, they just figured out that gold is the most efficient money. But again, it's the key to holding society together.
Our listeners know that the market has chosen gold as the best form of money for thousands of years, as you've just explained, but it hasn't been openly used as money in recent decades. Talk about how and why gold was booted out of the world's monetary system, at least officially.
Well, what's happened, and this also goes back to ancient times, it was generally the rulers of countries that said what the money was going to be. Best case is when the people themselves decided what the money was going to be, but a lot of times the rulers of those countries got involved with coinage. They put their images on it. They set the standards. But a long time ago, people at the top of the heap figured a good way to steal was to debase the coinage. So in Renaissance times, when they started having precious metals as money, they used to clip the coinage. In modern times, they figured out with things like fractional reserve lending that they could really, in effect, debase the money completely. The problem with gold from their point of view is that gold protects the money. So if you have gold, you have what you have. The way I like to say this is there's no counterparty risk with gold. With everything else, you have counterparty risk that somebody will do something that would damage the value of your currency. So, for example, if I pay you with a check, Mike, you have counterparty risk that the check may not be good. And if I pay you with a dollar that we call a dollar today, which is not a dollar, but what I call a dollar today, you have counterparty risk that the issuing authority, in our case it's the banking system, the Federal Reserve and the banks, will depreciate the purchasing power of that money. And they tell you right out that they're going to do that. The jargon for that is called inflation targeting. And so you're always at risk that after some long period you're not going to have what you think you have, or you're not going to pay what you think you're going to get paid. However, with gold, it is what it is. And by getting rid of gold, they're able, in effect, to engage in really a massive amount of thievery under the color of law, of course, where they transfer the wealth of society from the people who earn it, mostly ordinary working people, to the people who are in charge of the monetary system. And we've developed on this end of the phone data from primary sources. In this case, the Federal Deposit Insurance Corporation. They have on their website one line for each year going back to 1934 when they got started of all the banking statistics. And up until the last tie to gold was broken, and that was in 1971, the money that went to the banks, if you take, I can send anybody a chart on this if they wish. He says, just send me an email, larry@larryparks.com. It was a small amount of money. It was some number of billions. Since the last tie to gold was broken in 1971, it's in the trillions in dividends to their shareholders and in trillions in compensation to their employees. That it would not be possible with gold. And also in the sense of the politicians, and there's a very important book that people should take the time to read. It's called Fragile by Design. It's by a Columbia professor and his partner at, I think, University of California, a guy named Stephen Haber. It's called Fragile by Design. And they document very nicely that there is, on a worldwide basis, what they call a grand bargain between the banking systems and the monetary authorities, banks, in effect, to have paper money. And when you have paper money, you can have unlimited spending. So a lot of people complain about the deficit, about debt and whatnot. Well, with paper money, there is no limit to how much money you can spend. And if you have unlimited spending, you get unlimited government. And if you have unlimited government, the people in charge have unlimited power. They like that. Gold stands in the way. And so what they've done at this end in our country is, even though the Constitution guarantees us, promises us gold and silver coin as money, they've pretty much gotten gold out of the system, and they've done it right from the get-go. I mean, right from the time, right after the Revolution. And there's a ton of stuff from the 19th century where they recognize that gold is antagonistic to the paper money. And of course, the way they get you to use it is they force you to use it with what's known as legal tender laws. Again, another abomination.
There was a recent documentary financed and distributed by the Financial Times, and in that piece, one of their experts says gold is like, quote, shiny poo. He goes on to say that people who like gold are people who like to play with their poo. A silly comment, to say the least, but on a serious note, how do you explain the disdain for gold among financial elites, Larry? Because this individual's comments are quite often shared by many.
I can explain it in 4 words. Gold pays no fees. So the people in the financial world, especially on Wall Street is a fee business. So when people have savings, and a lot of people who are concerned, especially people who are at the upper end, they're concerned about intergenerational wealth transfer, leaving money to their kids. And people who retire, who are facing retirement or plan to retire, they have an issue. How should I allocate my money? And as far as Wall Street's concerned, they want you to allocate it in a way that generates fees for them. In the case of gold, and really the best thing that people can do for savings for the future is to buy gold. I mean, my favorite are U.S. Gold Eagles, and put them away. But if you do that, where are the fees for Wall Street? And so what they've done, and it's really incredible what they've gotten away with in the pension business. So, for example, in defined benefit pension plans in America, there are roughly $10 trillion worth of investable assets. $10 trillion. And no gold. The only gold position that I can identify is the Texas Teachers Retirement System. They have a $1 billion position in physical gold out of roughly $140 billion of investable assets. But the other $10 trillion, there's no gold. And they have roughly something on the order of 20-some-odd%, I think it's like less, I look around 24-25% of these assets in fixed income. On the theory, these are government bonds and corporate bonds, on the theory that people are safer. But in fact, the icon of American investing, that would be Warren Buffett, he said in one of his chairman's letters from his Berkshire Hathaway company, followed up with an article in Fortune magazine, that the most unsafe, the most risky assets are currency-denominated assets. And he specifically targets bonds. And the reason they're unsafe and risky, and is the only risk that you have to be concerned about, is that at the end of the holding period, that you have less purchasing power than when you started. And the answer is that things like fixed income, that's a guaranteed loser. And so how do you explain that you have $10 trillion, you have roughly $2.5 trillion in the most risky, most unsafe investment, and no allocation to gold? And of course the answer is, as they said, gold pays no fees. And so really what you have here is really cheating people on a massive sketch. I mean, it's unbelievable how they've gotten away with this. And in the last couple of years, there's been talk about having these investment advisors having a fiduciary responsibility to their customers, and they defeated that. So basically, the way Wall Street works is that they're in it for the fees. If the customer gets a good result, that's a happy accident. And so today, and I'll tell you, Mike, it's an incredible scandal. It doesn't get enough press. There's 150 of these so-called multi-employer pension funds that are on the Department of Labor critical list, which is to say they're bust. And millions of workers are involved. And, I mean, what's their remedy? I mean, what should these people do when they turn 65 or 70, whatever, and they can't work anymore, and their bodies are broken from the work that they used to do, and they have no money? How are they supposed to live? And so really what's happening in the country today is that there is, I perceive, a huge swing towards socialism. And in my view, we are at best 2 election cycles, maybe 1 election cycle away from the country going socialist. And I don't know how many people watched the State of the Union address by President Trump, but he went out of his way to say, in very strong terms, he said, we're not going to have a socialist country. Now, you've never heard any other president say something like that. And the fact that he felt compelled to say that, they recognize also that there is a swing towards socialism, and that would be an enormous tragedy. We are on the glide path right now to Venezuela.
Switching gears here a little bit, you talk to mining executives and you have your finger on the pulse there. So I want to ask you, do you think they believe there is price suppression in the metals markets? And as a follow-up, if they believe there is, which to us it seems hard to deny at this point, why don't mining executives cry foul? Because it seems as though their companies would be the most impacted. Is that they just don't want to call out the very banks that they're so dependent upon for credit or something else? Because the lack of an outcry from mining leaders has always baffled me, Larry.
Well, it's not only baffling, although I'll give you an explanation for it, but it's disheartening. You know, these folks have a fiduciary responsibility to their shareholders and also to themselves, but except for people like Rob McEwen, a very good guy, and Rudy Frank. Rob McEwen has McEwen Gold. Rudy Frank at Seabridge. Very few have any kind of material interest in the companies at all. I mean, they're in it for the payroll. But in their defense, and it's not a great defense, but it is a defense, they don't know anything about this business with gold and the monetary system. I mean, these guys, and I don't think there's any women running any of these companies anymore. There was one woman. She sold out to Barrick some time ago. I forget her name. But basically, these people went to the Colorado School of Mines or its equivalent. Some of them have accounting degrees, and that's it. And also, until recently, none of these people were from America. So if you look at all the major gold companies, or important gold companies, they're all headed by foreigners. So they don't know anything about the constitutional issues here in America. Why would they? So right now you have two. You have this fellow, John Thornton, who just took over a couple of years ago, Barrick Gold. He's an American. And Gary Goldberg, who runs Newmont. But before Thornton took over was Peter Monk. Peter Monk came from Hungary, grew up in Hungary, educated in Switzerland, considered himself a Canadian. Newmont was Jimmy Goldsmith, a Brit, and all the rest are from other parts of the world. I mean, nobody knows anything about the provisions, the history, and it's really America that's led the way on this, not any other kind of country. So, and there's a whole story to this, and I know we only have a few minutes for this podcast. But back in 1944-45, when the Bretton Woods Conference met, really the die was set there to get gold completely out of the system. Roosevelt did his part in 1933, but after Bretton Woods, and the idea was that the United States dollar would be convertible into gold for foreign governments and foreign central banks. At that time, it was still a felony for Americans to own gold. And that's an interesting question that you don't get an answer to. I mean, what is the public policy justification for making gold ownership in America a felony? Where have you seen that question asked in any economics textbook? And basically, the guys who run these gold companies, they don't know about this. And why should they? They're geologists, they're mining engineers. It's not part of their study. Here in America, the educational system is highly controlled, especially at the college level. Nobody gets ahead in economics talking the way I'm talking. And the Huffington Post, somebody did a study. It turns out that, if you want to get ahead in the academy, you have to publish. And it turns out that just about all the important economic journals are edited by present or former employees of the Federal Reserve. You don't get ahead. So basically, there's a lack of knowledge, and gold is denigrated. And so that's quotes that you gave from that Financial Times. Imagine the Financial Times sponsoring, I think that documentary, it's called something like The Dangerous Obsession. If you go on YouTube, you can search those keywords, dangerous obsession. I mean, it's just outrageous that an expert should say it's like poo. I mean, this is really crazy. But that's the level that we have now. And when you start talking about gold, people pigeonhole you. They say, you must be a gold bug, which is a derogatory statement. Anyway, as far as the guys who run the mines are concerned, they're in it for the salaries. They get good salaries. And like I say, very few of them have any skin in the game. And that's it. They don't know the vocabulary. They don't know what you're talking about. They defer to the World Gold Council, which is basically the World Jewelry Council. And that's been a thorn on my side the whole time I'm at this.
Yeah, that's, I think, the conclusion we've drawn as well. There's no great explanation as to why these guys are completely AWOL when it comes to the suppression schemes. We have had Keith Neumeyer, CEO of First Majestic Silver, who was a very outspoken individual when it comes to the manipulation, and at least there are some out there that are doing that. Well, Larry, as we begin to close here, tell folks how they can get involved, or perhaps how they can partner with you in your efforts to help advance sound money policy, other than making a fully tax-deductible donation to FAME, which can be done at fame.org. Talk about what people might do to join in the fight to help restore fiscal responsibility and sound money to our nation's monetary policy.
Well, the first thing, they're going to have to invest some of the most valuable resource, and that's their time to learn about this. And we have on our website, especially the issues summary. I mean, it's simple to do. There's a lot of cognitive dissonance here, but we could use introductions, especially introductions to trustees of pension funds. And one of the big opportunities, I think, to get interest in gold, we need to build a constituency for gold in the United States, and there is no such constituency today. I think in December, it's a proxy for this, the Mint sold something like 3,000 gold eagles. I mean, that's nothing. It's like a tenth of a ton. To put that into perspective for you, the mines produce about 3,000 tons a year, and there's roughly 200,000 tons above ground. A tenth of a ton is nothing. And you know, because you're in the business, people keep denigrating gold. So really, the opportunity to build a constituency is to get gold into pension funds. And I know you know about this, Mike. I don't know if your listeners know about it, but we just had 3 bills that went down in flames in Wyoming, which were going to compel the state of Wyoming. We had about 17 representatives out of 60 vote in favor of it, but all of these pension funds are naked. And if these pension funds just had some gold, at least people would start taking an interest in what's happened here. And what's happened will not stand the light of day. Like I said, this is just out-and-out thievery, stealing from ordinary people their future payments. It's not like they come to your house and take what you have, but really we're on a glide path to Venezuela, as I said, but we could use introductions. So if people can't make a donation, refer us to a trustee of a pension fund, any kind of pension fund. And I'm particularly interested in people who run pension funds for organized labor. And the reason for that is that organized labor, they employ lobbyists, and they have pull. And they're the principal victims. So they're the ones who could really make a difference here.
Well, it's certainly been a great honor to speak with you, and we greatly enjoyed the conversation. Keep up the great work. You guys are doing fantastic work there. People should go to fame.org and make a contribution. You've just heard Larry. He's dedicated a lot of his life to this effort, and it's a very noble one. And we certainly appreciate you coming on the Money Metals podcast. Take care, Larry.
It's a real pleasure. Thank you, Mike.
Well, that will do it for this week. Thanks again to Larry Parks of the Foundation of the Advancement of Monetary Education. For more information, visit the website fame.org, and please consider making a contribution to this important and vital cause. Again, you can do that and find out plenty of other information on these topics as well at fame.org. And check back here next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Gleason with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865 or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.